There are interest rates. So you hear about the interest rates often reported in the news. Interest rates are going down, interest rates are going up. What are they and what do they mean? So basically, interest rate is a cost of borrowing money from a bank or a credit union. Okay, so in order for you to borrow the money, you, the, the bank or credit union will have to look at your credit worthiness, and so use a credit score to figure out credit worthiness. So higher credit scores, FICO scores, would mean greater credit worthiness, and they look at other things like your what you own, your assets, and all these types of things, and they would determine through all that the level of risk that you have on defaulting, of not paying back the loan, and then they set an interest rate. So when things are really good in all these areas, you get lower interest rates. If they're not that great, then you're going to have to pay a higher interest rate. So the cost of borrowing increases over time. So interest rates are really important. So the longer the loan, typically the higher the interest rate. The lower the loan, typically a lower interest rate, because the longer the loan, the greater amount of payments that you have to make within the future. So it adds up in terms of interest costs. So interest rates you often hear about in the news, and another important economic concept.